name is Katalin Kálai. I'm the project manager of NATUREFIN project on behalf of Corvinus University of Budapest. The aim is today's webinar, which is the second in the row, is to learn about the finance for nature, private and public funding for biodiversity. Our presenter today will be Péter Juhász. He is a professor at our university, but he is not only a professor, he is also a program director for Masters in Finance program. Also, he is a trainer, he is a consultant, so he has lots of experience. So I don't want to waste his time and our time. I would like to say thank you for Péter for joining us, for accepting this request to tell us things about finance for nature. Péter, the floor is yours.
Thank you so much. I'm honored to be here with you today. First of all, let me ask whether you are able to see my slides. Would you
Yes,
confirm
I can see it very well, yes.
Wonderful. Okay, so let us hope everything goes right. It seems that we will have a 90-minute session. Later on, we will have a short break and we will meet for another 90-minute session. As Katalin very correctly stated, we will talk today about the role of private and public funding for biodiversity. And I assume here that most of the participants don't have a lot of financial background there, so I will start from the basics so you get a good overview of all these topics here. So first of all, I believe we have to clarify what biodiversity is and biodiversity finances. I mean, actually, the definition would say that anything that is linked to raising and managing capital for a project which would support some kind of sustainable biodiversity is considered to be biodiversity finance. So it won't include only how you would collect basically the money that you would need for projects that protect or promote biodiversity, but it would also include to achieve that the future returns and the future risk associated with this project would be in line with the requirements of those providing you the capital. Now, traditional finance and biodiversity finance are a lot similar. However, there are some main differences which we have to understand, because we cannot automatically use all the traditional financing tools for biodiversity finance. First of all, we have some specialties regarding the stakeholders. On one hand, traditional finance would consider an investor who would do a project, maybe be in contact with some suppliers, some buyers, and it is him collecting all the returns and taking up all the risks. Now, in case of biodiversity finance, we hope that our projects will focus on creating something that has a positive biodiversity impact. And biodiversity would not only be there for the investor, which means there will be something we call externality generated, where not all the costs and benefits of an investment decision are taken up by the person investing into that project. Now, how is that a challenge? If you have some externality, which you don't realize yourself, then whenever taking your investment decision, you may not consider those effects. So whenever deciding about pollution, you may overpollute because some of the losses caused by the pollution would be taken up by other people nearby, and it's not you suffering. Now, here we have the opposite. We hope that we have a biodiversity project which would have positive externalities, but because there will be many outside of the project taking some benefits, and maybe they will not contribute to your project, it might be that you won't invest as much as needed for to be in the optimal position, simply because some of the advantages of your projects would not be considered. The same is true for risks. Some of the risk might not be taken up by you. If you don't take up those risks, then maybe you don't consider them as risks at all. You don't even think about those effects, because of which you may go for a far too risky or far low risk alternative, depending on what kind of return you can achieve. A classic example in case of biodiversity finance is that your project, let's say restoring a forest, would hinder floods. And in that case, maybe it is not only you, or absolutely not you, who could be hit by those floods. There is an additional risk there that you manage, you decrease that risk, but because you are unable to collect any kind of fees for it, you may not consider that the risk to be removed, so this advantage will not be considered in the project, and because of that, you may spend less, or you may choose another project to do because you don't have all the information included in your investment decision. On the other hand, we have a huge difference in the aims. In case of biodiversity finance projects, we usually have some kind of minimum requirement for biodiversity, at least do no harm. But in most cases, we consider something to be a biodiversity project once there is a biodiversity positive effect. And in that case, once we see the minimum requirement is around 0 and we have some positive outcome, we should maximize that in the first row instead of maximizing our monetary incomes. So it's pretty different from classic financial projects where your at most aim is to maximize the cash flow that you will collect in the future. Here, we are willing to maximize the biodiversity positive outcome, and then we hope that even in that version, we will get enough of cash flow so our investors will have enough of return considering the risk they take. Then we have additional challenges linked to our resources, because here we should consider so-called assets that are actually not traditionally considered to be asset by accounting or finance. So nature is not owned by the company, because of which, of course, the company cannot show it as its own wealth. So whenever you improve the status of nature, this improvement will not show up as an increase in the wealth of your company. And if that would not happen, you may focus on other dimensions where the wealth of the firm would be growing. So we need here a special accounting system, a nature accounting system, that would focus on all positive effects even outside of the company. And also, of course, it should address all the possible negative effects. So basically, while traditional firms would focus on boosting their own value, here a company that is in biodiversity finance should be focusing and boosting the value of nature or biodiversity outside of it, and beside of that, it should maintain its living so it can boost the natural resources in a long run. Now, because of measuring the output is already a challenge, it is very hard to put that into the classic financial performance measurement. We need to use new kind of financial measures, maybe by translating nature positive outcomes into financially measurable, monetary measurable quantities, or by just dropping money as a measurement unit and trying to measure outputs in a different way, like number of species saved, habitats restored, or some floods prevented. But the issue with that is that very often these are hard to measure, hard to estimate, because we cannot contrast whatever was the end result of our work and whatever would happen if we would not do the same project. In case I don't operate a company, I know I won't get any cash flow. So I have an absolute 0 point as a comparison. However, in case of nature positive projects, we cannot exactly predict what will happen without us doing a project. We can only observe what happened after we did the project. And then it is hard to measure by what extent we have improved the biodiversity or any kind of other natural resource. I have here a list of unique traits of biodiversity finance, so you understand why it's a challenge even for those specialized in finance to deal with biodiversity finance projects. On one hand, you will have a wide range of stakeholders and goals. Notice that a classic company, as I mentioned, may have buyers, may have some suppliers, you have your own employees, your management, your owners, and more or less that's it. Of course, you have some connection with the state and local communities, but if you follow all the rules, you pay your taxes, then actually you just have to take care that your main stakeholders are happy with your operation, and then you are a successful company. Now, in this case, because you focus on restoring or creating additional biodiversity effects, you will have many stakeholders, including nature itself, and also you will have a number of different people who may take profit of your positive contribution you don't even know. And then because usually these biodiversity projects have a huge local effect, but not a global one, you would have a number of local stakeholders who are for or against a certain kind of aim to be achieved. Like if you restore the forest, you will have more wild animals there, and if there is a road crossing that forest, then there will be definitely more accidents where you would have animals meeting cars. So you will have protesters who would be willing you to stop the animals going on a road, and then you will have the hunters, and you will have also people who are willing to just enjoy the forest, and they all want to have a say once you restore the forest. And because of that, it might take ages until you collect the opinion of all those stakeholders and you map all the goals and try to optimize so you can come up with a solution that still has some positive biodiversity effect. It's still somehow reasonable from the financial side, and no one is absolutely against that and would block the realization of the whole thing. Very often you need a political support for this. However, because these decisions take far, far longer to take than classic financial decisions, the flexibility of business fades away. And once you have a political cycle for 4 or 5 years, then maybe while you initially had your political support, by the end of the preparation phase, when you have to take the decision, maybe new politicians arrive and they have different focus, and you have to restart the whole thing all over again. Now, you also need to use, as I mentioned earlier, special indicators. How is that a challenge? Classic financial indicators are directly linked to accounting statements. So we can understand how to influence those, we know how those are calculated. Plus, managers have the feeling that they have some kind of direct effect on the change of those indicators. So what we might say is that one of our target in a classic firm could be return on equity, and if I'm good enough reaching a high return on equity, then as a top manager I will get my bonus. Now in this case, I should maintain some kind of return on equity for which I know already how to influence that and how to make my company financially more efficient, but I should do that by maximizing some kind of absolutely new nature-related indicators where the company may have a direct effect on nature itself, but we cannot be sure how this effect will be translated by the nature into some kind of indicators. So I may do everything, staying with my old example, to recreate that forest, let's say after a wildfire, but once I did everything, it still depends on nature, how successful I will be. If there will be a fire again, it will destroy everything I did. If there will be a flood, everything will be destroyed. If the weather is not nice enough, then again, we have a similar problem. So whatever we do to nature, we cannot force nature to come up with some kind of final output. We just have an assumption what to do so we can achieve these outputs. And also, most of these companies would not have a very special expertise in understanding how nature works. So you should hire biologists who can help you with finding the right measures and the right ways to achieve a certain indicator, but still there will be a huge risk, a risk which is very hard to measure and which is very new to financial decision makers. So of course they would be not very happy to enter a field where their performance is measured by indicators which they cannot directly influence, plus which they don't know yet. If we would have a lot of experience on this field, we would already know how to maximize the likelihood to achieve those indicators. We would have more interest definitely in these projects. Then we have a lot of trade-offs and priorities. As I mentioned, you have a wide range of stakeholders, and these all have their priorities. Some of them want to face safe roads, some of them want to see beautiful animals in the forest, some of them want to hunt there, and some of them want to evade flood, and maybe those all require different kind of species in that forest. And then we have trade-offs. So if I want to go for one of the solution, then definitely that would hurt someone else's interest. And it's not measurable by money. So we cannot say, okay, I will prefer this party and I will somehow monetarily compensate the other parties, which is absolutely typical in case of financial decisions, but not in case of biodiversity projects. You cannot do that, basically. We had the issue of these unique risks and returns. So what do you do if you are extremely successful in doing some nature positive outcomes, but you lag behind in financial targets? Can you just stand in front of your owners and explain that yes, we did not reach the required return on equity, but we saved 20 more species? Now, would they be very happy, or would you be immediately fired because there was a requirement that you did not fulfill and they don't really care about you doing more in another dimension? And because you need a special expertise here, you need to hire more people. Plus, you have far more transaction costs because you have to talk to far more of stakeholders. You have the decision process far longer. You need people here to be committed to the target for far longer. And this commitment may fade away over time. And it's very hard to upkeep this level of commitment if your financial resources are restricted. So basically, it seems that these kind of projects have a far higher risk on the return side, a far bigger transaction side, or transaction cost on the cost side, and also a far longer time need for realization. And these challenges are very hard to put into traditional valuation models. So at the end of the day, if you present here a nice biodiversity project which is maintainable, still it is very hard to judge whether this will be a successful one or not. It's hard to convince investors to take part because they would doubt that these valuation challenges are put into the traditional model in the right way. And because there is a quite huge lack in the literature how to value this kind of projects, you can only say that we believe this is the best ever technique, but you cannot rely on books or publications that would justify your choice of modeling. So all these would make biodiversity finance into a very special field, and that is why private investors would be not really willing to push into this area. You have also these additional challenges there, beside of the coordination I already mentioned. We see that resources may not generate high enough monetary return for private investors, so we need public sources to be used for financing. However, when you want to introduce public sources into these projects, then we get a problem in another dimension, because we of course have limited amount of public resources. So then decision makers at the state level would be contrasting very different biodiversity projects and will focus on optimally spend the limited amount of funds available, and they will have not to measure how much capital is being invested in order to achieve some kind of biodiversity projects, rather than how much of public fund is needed to achieve some biodiversity positive effects. And then they may prefer projects which need a very few amount of public funds, instead of going for projects which have the highest biodiversity benefit for 1 unit of invested capital. And this way create some kind of preference of the public funding towards projects that are very near to be doable on business basis without any kind of help, rather than focusing on projects which would do the biggest benefit for the community. And also because we need different kind of expertise, a lot of coordination, and we also need here very different sources of financing. We need new institutions that would support these kind of biodiversity projects in order to traditional financial experts to be able to set these up. If private sector is missing this knowledge, then maybe it's the state who has to create these institutions so that they can add the required knowledge and the required support in order the biodiversity projects would be a success. Now, I listed here the main reasons why private investors may evade biodiversity finance. As you see, I already mentioned low returns, long maturities. I mean, classic project, if it takes longer than 10 years, it's already a very long project. And then if you plant a forest, maybe you have to wait 50 or 100 years. And then we have the externalities, where, as I said, consequences of the investments are not completely taken by those taking the decisions. And there is an additional point here I added, which is free riding. If I know that you do a project which is advantageous for me, I may decide not to tell you that I have some advantage in that, so that you don't ask me or force me to contribute to the costs. I just stay silent, you do the project, and then I enjoy the benefits. So if I would just simply launch a questionnaire, do you want us to restore the forest, or rather you want us to, build a new bridge, then maybe you don't tell your real preferences. And if we don't know your preferences, we may take suboptimal decisions. Plus, of course, we cannot collect all the contributions, so we don't know who would be ready to pay some kind of fee or just work for free on the project in order to get that benefit at the end. So we will have less of resources. There is an extremely high risk of failure here, contrasted to business projects. We have a good experience in how to plan classic business projects and how to evade different kind of risks. Now, in case of nature-related risks, it's very often hard or not even possible to evade them. Just think about weather risk. So if there is no rain falling, then our forest will never grow. I mentioned already high transaction costs. And then a final point would be undervaluation of nature or nature positive outcomes, because it's very hard to measure. And there is little trust in the traditional investors regarding these valuation measures. They may not accept fully the results, even if we come up with some kind of numbers denominated even in money. They might say that, oh, we were too optimistic, maybe the value is less. And then because of that, of course, the decision will be again suboptimal, or they just try to evade because they see there is an extra risk in the valuation. Now, for biodiversity, there were a number of different financial mechanisms already developed in order to help evade these kind of shortcomings so we can really boost these biodiversity projects. One of them is the environmental fiscal reform, which would be linked to the state changing its current behavior and start providing tax incentives to projects that would focus on biodiversity positive projects, or remove simply harmful subsidies, or introduce fiscal penalties for those not doing that or doing harm to nature, which would definitely help these companies to promote projects that help them to evade the penalties, or because of removal of subsidies, it will be immediately clear that the prices of different kind of resources are different from what they were. And because us changing these kind of prices, we may see more clearly what kind of investments are worth doing. Recent debate going on, for example, in the Hungarian literature would be linked to whether fossil fuels would get subsidies by states. And of course, those interested in that business would say, no, of course, we never get from the state any kind of subsidies. Actually, we pay in a lot of taxes. And then the other party would say that, yes, but if those taxes are considerably less than the harm you do to nature, then at the end of the day, this is a kind of subsidy. Or if we keep on subsidizing building roads, and those roads are only used by cars that would be using gasoline, then at the end of the day, this is already a subsidy for selling gasoline. However, of course, streets are also used by electric cars, but to a far less extent. But of course, subsidy to railroads may be far less popular than building new roads, particularly because, for example, in Hungary, these roads would create a toll or fee income for the state at the end of the day, while if you build some railways, that will generate you only some kind of maintenance expenses. Now, beside of the state changing its way, looking at these projects, we may also introduce techniques where those who get benefits from the ecosystem services would be able somehow to pay for those. So if I restore a forest, I may try somehow people visiting the forest to make them pay for that visit, or to contribute some way to maintenance of that forest. There are a number of methods to achieve that those taking the benefits could contribute, either voluntary, or we could force them to pay. A method of that, of course, would be where you pay some kind of local taxes and the local municipality would contribute to this kind of biodiversity projects. So at the end of the day, it will be still locals paying for the project. We also have biodiversity offsets and compensation technique. There are companies that might have some negative biodiversity impacts at one location could somehow offset this negative impact by contributing to biodiversity positive projects either at the same location or somewhere else, so that at the end of the day, the net biodiversity effect will be at zero. Also, we may try to give some kind of compensation to those who would create some biodiversity positive effects instead of just using traditional, usually less expensive technology to do the very same thing. Then we might focus on creating a new market for green products. Of course, here the main question is, how do you decide whatever product is green? For that, we would need an independent authority of some kind, which can be trusted, that would very clearly define what green products are, and it would strongly control what kind of products can be marketed as green. If we create a separate market for products that that are meant to have a positive biodiversity effect, then if there is an advantage of traditional products to go on that market because they are cheaper to produce, but you have, let's say, a higher price for green products, then we will have the issue of so-called greenwashing, where companies manufacturing traditional products would do everything possible so their traditional products would look like green, and this way they would get some preferential treatment. What we might try is we might create a market for biodiversity outputs. A classic example for that is ecotourism, where you would have an area which would be special regarding its treatment and biodiversity, and then we try somehow to promote tourism in that area, and we try to achieve somehow that the extra return that the classic tourism service providers would collect will flow into some more biodiversity positive projects. We may want to create certain certifications that would mark sustainable timber or fisheries or organic agriculture, but as I said, we have to protect the system against greenwashing. We also have the biodiversity in climate change funding, where we try to connect the classic climate change funding methods with biodiversity positive impacts. And we want to introduce something like, for example, you all remember that we have the CO2 emission allowances, and we created a market for that. Maybe we could do something like that with biodiversity, where biodiversity positive impacts could have some kind of their own market, so those who would have a negative impact on biodiversity have to buy the compensation from those who have a positive impact. And we also have a tendency that international development finance would pay a very special attention to biodiversity. So international grants are available for those projects that have a biodiversity positive effect. Development banks would only provide you loans once you show that your biodiversity impact is at least zero, so you do no harm. and we have special grant programs where the target is some kind to achieve some kind of biodiversity enhancement instead of achieving or developing some kind of marketable product. So there is a lot being done so that the biodiversity projects are more popular with private investors. I have here some special finance instruments that are linked to biodiversity. For example, we may have bonds which would finance projects that achieve some kind of nature positive or biodiversity positive effects. That's the first level of requirement, and of course they should still pay you some kind of return, but very often we hope that investors, being happy with that green or biodiversity output, would be just happy enough to keep a lower level of return compared to traditional financial bonds. Then we have these biodiversity linked loans and bonds, which are different because here we have a minimum requirement, and these are a kind of covenant. So these loans could be only used by those having a positive biodiversity effect, and very often they may have preferential treatment or lower interest. Blended finance is something very special that we will talk more about later on, where we will introduce a combination of public, philanthropic, and private capital in order to reduce the risk of the investment. And this way, we need less of private capital, and you will see later on, by restructuring risks and return, maybe we can assure that private capital will get similar risk and return combination as anywhere else, so that at least they want to take part in these projects. I already mentioned these biodiversity credits, which allows you to market your positive impacts on nature, and someone else buying that to compensate his negative effects. We may have parametric insurance, where the risk of climate-related disasters would be transferred to someone else. So as I mentioned, in biodiversity positive projects, we have the company doing something to nature, and we hope that in exchange, if you want, nature will return with more biodiversity positive outcomes. And the extra risk that involves in the nature's reaction could be taken over by some kind of insurer. So in case there is a wildfire again destroying our new forest, or there is a flood destroying our forest, the loss is compensated, so we can restart if you want. And then we have something brand new appearing in the last 10 years is impact investing, where the private capital would be focusing on achieving biodiversity or ecosystem positive outcomes. And that's the final target, not the return to be achieved, rather than the return is measured in biodiversity dimensions, not in monetary returns. And that's a new trend where special funds would be willing to participate in projects in order to achieve those biodiversity positive effects, rather than just receiving financial return. Maybe they completely neglect that part. Okay, these assets can be categorized in many ways, like what kind of sources you can mobilize. Some of them can only focus on local resources, like when you create a local market for some green products. Maybe you can do it a regional or national way. And then you also have those international grants mobilizing international sources for a biodiversity project. These already raise a new challenge, because as we mentioned, biodiversity projects usually have an effect at the regional level at most, rarely at national level. So whenever you have an international grant, an international fund that you need to distribute across different projects, it's hard to decide whether it's more important to restore a forest in Germany or in Poland, or whether to stop wildfires in Spain or restore a forest in Hungary. So we have here an extra challenge that someone has to address not only the differences in the biodiversity positive impacts, what is worth more, a forest not being burned or a flood being stopped, but also whether it's more important to do it in Spain or in Hungary. And this extra challenge is very hard to overcome in a way that at the end all the stakeholders, all the countries, all the citizens are happy. Now, we can categorize these tools based on sourcing, whether they focus on private sources only, public sources, philanthropic sources, international sources, all of them at the same time. This is the blended finance. Or whether it is about attracting new funding, so we have more money to spend, or we just change the incentives, like in case of changing our taxation or subsidy system. And because of the change of the incentives, the total amount of capital that is available in the economy will have different preferences. So somewhere else, there will be less investment and there will be more investment in the biodiversity field. And of course, we can categorize these tools and methods based on the targets they want to achieve, whether it's a local target, a regional target, a national target, or an international one. We may declare that we want to reduce the chance of wildfires in whole Europe, or just in a country or in a region or locally, and then we may ask for different projects and then analyze them, whichever of those is more efficient, so it uses less of resources, so we could achieve the most of positive output from the available amount of capital. Okay, so we went through all the methods of biodiversity finance. We have seen the shortcomings and the problems. We understood that it's hard to receive private equity into these projects. And we also have seen how different kind of new institutions try to have to overcome this challenge by reducing risk, adding more of return, or just adding some more capital from other sources. But there are still implementation changes remaining. Here, for example, that the private sector has not enough experience or track record. So if I wanted to invest into a project and they say, okay, why don't you go for a biodiversity positive project? What I will say is, I have no clue how to manage that. I need to hire people, but there are not too many on the market because there is a short period of time for which we started these projects. So no one has really that experience and no one can show an impressive track record. I mean, if I go for construction and real estate development, then I will meet easily companies which have a track record of 100 years of developing whatever shopping malls. And then I can check whichever I like more and I can trust them because they managed already several times to build a new shopping mall. But if I want to stop wildfires, restore a forest, or just build a geothermal power plant, we will have a shortage of expertise. And even if people say that, okay, we have some expertise, then we ask, okay, how long are you on the market? And they say for 2 years, 5 years. And then if you are used to traditional markets, you would say, okay, that might be random that you still survived. Let us wait another decade. And if you are still there, then you have shown that you are good in this. Then we also have the regulatory frameworks, pretty weak and very often inconsistent from biodiversity standards point of view. So whatever is considered okay in one country could be not okay in another country. A classic example would be the EU Green Bond Regulation, where they go only for climate positive outcomes, and agriculture is excluded, while we could very well imagine that biodiversity positive impacts could come from projects in agriculture. And then we don't really have an agreement of indicators and measurement methodologies. So maybe one company would come up looking for investors and they say, okay, this is how we will measure our performance. And another company would approach the same investors with another set of indicators. And it's hard to see why they use unique indicators. Why don't they use exactly the same ones? So later on, we could contrast their performance. There could be a competition, which is absolutely normal in traditional finance. And the reason is because there is no agreement, general agreement on what is the best measurement for biodiversity positive outcomes. Then, to tell you the truth, most of the financial decision makers are not really aware of biodiversity risks and opportunities. So they just simply don't think about biodiversity, because of which they don't consider those options to be an investment opportunity or a project. And they don't consider all the risks they have, because of which they don't try to waive that by doing some new projects. So the projects are not even created, which would create a demand for capital and would create a demand for green product markets and so on. Simply, current or classic finance would go away and not even recognize investment opportunities. And finally, because there is a huge difficulty in quantifying and valuing biodiversity impacts, it is very hard to come up with a valid proposal for investors saying that, okay, if you invest here 1 million euros, this is the return we promise you, and these are the outputs you will get, and let's say in 10 years time we'll pay you back the money. Because the outputs we promise are hard to measure, saying that air would be better, or there will be more trees in the forest. And then they will be very suspicious, saying that if you don't do anything, there will be more trees in the forest. There is no point in promising that. Or what do you suppose? Shall I count the number of trees in the forest so I figure out whether you were doing a good job? And there will be always challenges here. We hope that new technology, like using pictures from made from space, could help us to better track biodiversity positive impacts, but this technology is pretty new. Now, no wonder, based on all this, that depending on who you focus at, it's a relatively new estimation for 2020, we see that per year there is a 700 million USD gap in biodiversity financing. So when we mean gap, or when the authors mean gap, what is calculated here, how much should be invested in order to keep the current level of biodiversity. So it's not about improving, it's just that we spend globally far less on upkeeping biodiversity sources or resources than what would be needed just to keep it constant. But as you see, the population on Earth is growing. So, of course, the demand for biodiversity services is also growing. So maybe maintaining the current level is not, well, would not be enough. There would be a need of enhancing these resources. Okay, so we have covered here the biodiversity finance part of the issue. Let us understand also what blended finance is. it is pretty important to say that blended finance was not invented for biodiversity projects. Blended finance emerged far earlier with a different purpose, but to overcome similar challenges. So what is blended finance? Blended finance is when you use sources or capital from different sources. These could be private sources, public sources, and philanthropic sources. Now, why you need to do this is because there are projects which would not be done on the market if all investors would follow their private interest. Why those would not be done is because some of the benefits are not realized by the investor itself. You remember the externalities? But those outcomes could be social, economic, and environmental at the same time. And as we go back to biodiversity finance, we only focused earlier on these environmental benefits. But notice that if I would run a bus from a village to a nearby city, then what I will have here is a social benefit for those taking this bus, and children could go to school, people could go to work and find a job in that town, and then I could ask for some money for riding the bus. However, maybe it would be suboptimal to ask for the market price of that ride, because at that price maybe exactly unemployed people could not afford to use the bus, so they will never find a job, or families with a lot of children could not afford all the children to go to school because the ride would be too expensive. So maybe if we would give some kind of subvention to the bus company, so they offer the tickets at a lower price, then we would have the people more happy because they will be more educated and more successful later on. Maybe it would pay off for the state in the long run, even for monetary term, because better educated and employed people pay definitely more tax. However, from private point of view, if I wanted to launch this bus connection between these two cities or villages, I would maybe not even start this coach connection, because there will be a lack of demand at the market price level. So we may see situations where some of the effects of my services would be not realized by me or by those paying, and because of that, private capital solution would not exist. Notice that these projects tend to have far high risk, or a return that is far low or far too uncertain for private investor to accept this investment offer and realize the project. Let us see what are or were the most common fields of usage of blended finance recently. On one hand, of course, sustainable development is a classic area of usage, because we have there a huge number of goals by the UN, like no poverty, zero hunger, good health, well-being, and so on, which are all there either for sustainable development of the society or sustainable development of the nature. And these projects are typically benefiting people who cannot afford to pay a market price for some of the services like education or healthcare. Then we have the infrastructure projects, road rehabilitation, clean water projects. Again, there, just imagine if I would do a market-based clean water service, then because all households would need clean water, if I attach them to my network, they will definitely not connect to another network, so there won't be any competition. I will be in a nature monopolistic situation, and this would lead me into a position where I could charge any price for water because everyone would need clean water, and I can force them to pay a huge amount, and I can realize an extraordinary high profit. So definitely we need there some kind of regulation. However, I will only serve with clean water rich people who are ready to pay enough for water, and I will not connect the area where we would have less well-off people living, because I know they would not pay the price of all my infrastructure investment and upkeeping the system, plus providing clean water, and then clean water would be only available to rich people, which would be, of course, not good. Then a lot of climate actions where most of the positive externalities, evading global warming or effects of pollution, may be taken up by the next generation. So it is impossible to make them pay right now. So we have to hinder that the current population is overusing these resources. And then we have the nature conservation we talked about. Here is where biodiversity would come into the game. Let us see how blended finance and biodiversity finance meet. We have finance, and as I said, a tiny little part of this is nature finance. Within nature finance, we have a number of areas. For example, you also have climate finance, and you have biodiversity finance there. Then macro finance and finance would cover how to spend the money of the public and how financial decision at a global level would be taken. And then we have there the blended finance, which will both connect to traditional finance, nature finance, biodiversity finance, and macro finance. So whenever you check the literature of blended finance, you will see that most of the projects described would be linked maybe to building dormitories of private investors and the state together, and then offering that to students at a reduced price. So it has limited connection to biodiversity or nature finance, but maybe that gives also us an advantage, because as we have seen, one of the most important issues with biodiversity finance was that we don't really have a tradition and an expertise in that field. But we have plenty with blended finance, actually, just in another area. So if we try to use blended finance in biodiversity, then we have the advantage of having some experience already. We know how to reduce some of the risk, linked at least to the blended finance way of financing. Let me explain you how this blended finance works. For this, we need a little introduction into finance, so I hope you are ready for that and not too tired yet at this point. Just imagine we have a certain capital need. I have here this in blue, for a certain project. This project would generate also some kind of financial risk here in the middle, and then I have a financial return for that. Basically, we want that the return we receive is in line with the risk we have to take up. The higher the risk, the higher the return we wish to get. Now, if a project has a return that is in line with its financial risk, then it's doable from private equity sources. Investors will go there, check the risk-return combination. I'm very happy to take part. Of course, if there is limited capital available in the current field or in the given country, then they will only do projects with the best risk and return combination. But whichever is there, sooner or later will be done if risk and return are in line with each other. However, in our case, as we have seen, the main problem is that some of the return of the project would either be realized by someone else, that was the externality, or maybe some of our returns is not a financial return. We just have more spaces, a better habitat. Maybe we just have a more beautiful view, or we just have another forest growing or restored, or we have less of floods. And that's our return, which is hard to measure in money. So when private investors arrive, what they say is there is a capital need, there is a huge risk, and the return is far less than what is needed for that level of risk. So they want to evade this project completely. Now, let us imagine that we have to solve this problem. There are two types of private investors generally, to simplify the whole thing. We have the equity investors. The equity investors are characterized by providing you a bunch of capital, and they usually take up more than the proportional part of that investment from risk, but they also want to take a comparable proportion of the return. So what you see here is that this green area for investor in investment here, this is a smaller part of the total investment than the return they ask for from the total amount of return. However, at the same time, the risk proportion they take up is in line with the return they want. So basically, they provide some money, they take a higher bunch of risk, but they want to be compensated by a higher amount of return. Now, the other type of investor, let's call them the bank, would provide you some kind of loan, credit, and they want to take up a very low amount of risk, and they want also just a compensation for that amount of risk being taken over. So debt is cheaper than equity because they take up less risk. However, usually a bank would not lend you more than whatever you put in form of equity, but because both of these investors will be asking for a compensation in line with the risk they take, if this project would be doable market basis, then a combination of investor 1 and 4 would be perfectly taking up the total capital need of a normal project. Equity owners take more return and more risk. Banks would take less of return for 1 unit of capital and less of risk. However, in this case, we don't have enough of return. So we should have some more investors coming in who are not willing to get compensated for the risk they take up, which is pretty strange. But let's say we have an investor 2 giving really very little of capital and requiring very little of financial return, however taking up a considerable amount of risk. From a traditional financial point of view, this makes little reason. This is kind of wasting your capital. Why would you take up far more risk than the return you get for it? It seems to be suboptimal. Or we may need another investor which provides us a huge bunch of capital and ask for proportionally far less return, and also takes up more risk than the return required. So you see here, this return part here is lower than the risk taken up. Why would investor 2 and 3 do this? we could come up with two explanations. First explanation is, it might be there is an indirect financial return from this project. What could this be? Maybe if I'm the state, I guess I can get some extra tax income. So beside the project generating me some kind of a direct financial return, actually I will also collect some tax from the project, and all the people the project employs would pay me some taxes. And maybe if this project will be realized, then there will be an economic boost in this region, and all the other businesses would pay me more tax, and there will be higher employment. And because of that, I will have to pay less of subsidies to unemployed people. And at the end of the day, I get a lot of monetary income. But it might be also that I can evade some kind of costs. If this project would hinder floods to happen, and it is my job to pay for restoration after floods, then that is a good business for me. Maybe I would have higher sales. Just imagine I run a hotel and this overlooked a beautiful forest, but there was a wildfire and now the forest is gone. So people are not really willing to stay in my hotel because they can overlook just an area with burned forest. So if there would be a project where someone would restore the forest, maybe I would have a higher sales. So it is in my interest that this project is done. So I will get a financial return, while it won't be the return of the project. And of course, maybe I will just face less of nature-related risk because the project is realized. And just imagine I'm building a fence around the forest so that deers would not leave the forest, and I am a farmer and some of my crops are being eaten by wild animals. If there is this fence, then the wild animals hopefully will eat less of my crops. So it could be that I personally realize some kind of financial advantage that would not go into the project's return, but for me, this project generates me return from the project side and from my own business side, and makes reason to invest and take less of the return. And there is another explanation why we may have some people, because yeah, you may say, okay, if that's the case, then investor free has to receive even more indirect financial return. But what can be is also that there is a non-financial return, like biodiversity, climate, ecosystem services, well-being, or just more developed communities, some kind of educational or cultural advantages, and so on, which are considered to be a return by investor free in this case. And they don't mind getting less of financial return if there is a big amount of non-financial return. Now, a classic example for that is the state, because what the state does is actually collecting taxes from people and converting those taxes to some extent over to non-financial returns. Like, you pay for the police and then everyone feels secure, or you build roads and then it's easier to move around the country and everyone is more happy, or you pay for subvention for keeping cultural heritage, so then tourists could go there and just check out how folk dancing is done. And maybe you would set up some kind of system to remove disaster effects, and then you have to spend less on that. So at the end of the day, if we have some investors who have either indirect financial benefit from the project, or who have some non-financial returns that they also consider as a form of return, and they don't only focus on monetary returns like private investors do, then it might pay off for them to take less or proportionally less of financial return and more of financial risk, in this project in order this project is being realized. Now, because of that, this blended finance projects would have a number of relatively complex financial instruments to allow you to make an investment which would have proportionally less or more of financial return and financial risk than the proportion of your investment. The classic equity is when private investor keeps the ownership of the project. That was investor one. But then we may have some debt which behaves like it was equity. So it takes up more risk than classic bank products and also requires more of financial return. We have structured finance, which gives us the opportunity of separating different categories, even within equity or within debt, so that we have some of the investors suffering total loss initially. Normally, if a company would suffer loss, investors, equity investors, would take up the loss proportionally. If you gave 60% of the capital, there is a loss, you take 60% of the loss. However, if there is a first loss capital structure, then maybe an investor gave you just 10% of its capital, but if there is a loss, first we deduct all the loss from his capital, and once it's faded away, it's only afterwards that we would decrease the capital of all the other financiers. Then we may have those social impact bonds we already mentioned, where the bonds would require you to achieve some kind of social impact or biodiversity impact. And if they get that, they are very happy with a lower level of return. Notice that very often these bonds ask for a higher return if you don't achieve that social or biodiversity impact. Then we may provide you subsidized loans. On one hand, it could be that we provide you more loan than what would be given to you by private banks, or we give you the same amount of loan, but we ask for even less of return, while our requirement or while our share of the risk is the same. Then we may provide you some kind of risk insurance, which would mean that in case there is a loss, there would an outside insurer company paying you that back. So if you are lucky, we will never meet. Maybe you pay a small amount of fee, but if you are unlucky, all of a sudden, the insurance company would repay you that. This is very similar to what I had on my earlier slide as investor 2, taking a very small amount of return, but taking up a huge amount of risk. Then we may have grants. And these grants usually provide you capital, which require no return at all. And so, because it provides you a kind of financing, if there is a loss, it would also suffer a kind of loss, meaning that it takes up a part of the risk, but no part of the return. Then credit enhancements make it possible that traditional private loan would be less risky for the bank providing it than what it would be without. So maybe in case we cannot repay the debt, there would be someone who guarantees the loan repaying it instead of us, because of which bank is ready to lend more, maybe even at a reduced fee. Beside of all this, we could support this blended finance mechanism by technical assistance. So it's not providing you money for capital, not giving you extra return, not taking away any of your risk. Rather than we help you to organize the whole thing. We explain you how to create these kind of structures so that you are more likely to be successful. And also we may help you to connect to people who are interested in such investments or who have experience with such investment. Maybe we would certify that your project is green enough, you have a positive biodiversity effect. Maybe we would regularly check your report on your biodiversity effects and testify to all the investors that you are on the right track, because of which you can issue social or biodiversity impact bonds, or you can convince investors to invest with you because you will be monitored by specialists, and it's not up to them to judge whether you really achieved the biodiversity targets you promised. Then we may offer you tax credit or revenue guarantees. That's basically increasing the return of the project. So earlier we said the problem is why it's not doable for private equity is because contrasted to the risk, the return is far too low. Now, if the state provides you an extra premium for buying, let's say, electricity from your power station, which is, let's say, using geothermal energy, and because of that, maybe generating the energy costs you more, but there is a premium price at which it is taken off, then at the end of the day, your return will be in line with your risk. We may also create supportive policies and offer you political guarantees. So we will not hinder your work, or will make it possible or make it more easy to set up a company with a biodiversity positive aim or outcome. And the political support guarantees that if we promised you a continuous subvention, then you will really get it over time. It's not that because your project lasts for 50 years, every second government will annul the subvention that we promised you. So this way, we can either decrease the total risk of the project, or increase the total return of the project, or invite investors who take up proportionally less of the financial return than whatever they take up from the risk. And this combination is good enough so that from financial point of view, private equity or private capital sources would earn whatever they would earn elsewhere regarding a risk and return connection. I have here a list of different structures that are used in blended finance so that we get enough capital. So, for example, here we have the concessional capital, where there is a multitude of different private or public sources adding up the capital needed. Very often, we have philanthropic investors who provide relatively low amount of capital, but their appearance is a kind of guarantee that we achieve this nature positive effect, because they only invest in case we would have proven that our biodiversity impact will be high enough. Then we also have, usually with this kind of concessional capital, a lower than the market rate, meaning that they take up less of the return than what they take up proportionally from the risk. Then guarantees and insurances, again, sometimes just the appearance of a specialized philanthropic actor already acts as a kind of guarantee for other investors that someone will do the professional monitoring of the biodiversity part. But of course, if you have special insurance against nature caused disasters, or just a general insurance that enhances the quality of your credit, it will help you to get more private source funding. Then technical assistance facility, we mentioned already this one, would be just a kind of office offering you connections, experience, how to set up something, a structure of financing, a company targeted at biodiversity outcomes, so that you are successful. They would collect earlier experience. They very often merge blended finance experience from other fields, not biodiversity. They would have good connection to different biodiversity experts. They would have connection to grants and also to private financiers. And then the pooled investment vehicles are known very well in classic finance too, where we would have different kind of investors collecting their money. And then once they did that, they would have this investment vehicle investing in these projects in order to create a diversification effect for themselves. So maybe there would be a special company dedicated to collect funds from very different sources. And then this investment company would invest into a variety of different biodiversity positive projects so that the total risk is diversified and the structuring of the blended finance should not be done for each of the project. Rather than there is a central unit where we collected the money, and then the job of the investment company is only to handpick the right biodiversity projects. We also need to do some risk mitigation. Very often this is taken over by philanthropic capital taking part in this project. And sometimes we have a third-party certification institution which would overlook the operation of the company and testify that we are on the right track, that we really do projects, that it is not greenwashing. Beside of that, we also need so-called financial engineering, which will help us to restructure the risk and return of the project so that it matches with the risk and return expectations of the different investors. That's what we just saw in our earlier figure. And then, of course, mitigating risk of a biodiversity project may involve providing some kind of subsidies which enhances the return we make, providing guarantees, reducing the risk that we take, and first loss capital, which would take up a part of the risk instead of the other investors, so that they are more willing to invest. How would blended finance facilitate investment? There are a number of advantages helping to convince private investors to take part in these projects. Point one, if you have this blended finance structure, then the high investment risk can not be neutralized, maybe cannot even be reduced, sometimes yes, but maybe it can be redistributed. So we may have some investors who are keen on taking more of the risk, and some other investors who are not willing to take too much of risk. You see, if we just have one type of investor, they all have to take up proportionally the same amount of risk. But if we redesign the financing structure, then we may offer low risk, low return tranches of ownership and high risk, high return tranches of ownership too at the same time. If returns are far too low, then we may try to enhance that by providing concessional capital, which you remember on one hand requires less than the market level of return, and also reducing the risk or your loss or reducing your transaction costs by providing you technical assistance. And this technical assistance will save you a lot of chores and at the end of the day, you will be more trusted. If you have limited access to finance, then maybe by involving a well-known blended finance institution, you can solve this problem. Development finance institutions are there exactly because they build up an expertise in choosing great biodiversity projects, and the finance institutions themselves are financed by a pool of very different funds. And these development finance institutions may also have some local intermediaries, so they find direct connections to these projects. Later on, I will show you examples of these, so you have a better understanding. And if there is a sustainable development goal financing gap, then blending this into other projects or blending it with some kind of other aim that is more fundable from private sources may help you to realize your goals. And that's also something that blended finance investor can help you with. Okay. What are some of the innovative blended finance instruments for biodiversity? So that's where the two of our focus areas would meet. We have something called revenue stacking. This is about to boost the total return of your project. On one hand, you can combine traditional sales, of course, but beside of that, you can go on for collecting certified sustainable commodity income, carbon credits, biodiversity credits, ecosystem service payments, and a lot of different things that all together may be able to generate you an income that is in line with your risk. Then we have something called debt for nature swaps, where we have debt obligations that are spent on nature conservation funding. And we hope that if we achieve that nature conservation target, then this debt obligation will not be to repay. Very often they will convert it either into a grant or into an equity, so we don't have to repay it. Carbon credit frameworks helping you to somehow create a market for all your positive impacts that you have. I wrote here carbon credit, but of course it could be biodiversity credit or carbon biodiversity credit, any kind of combination. And then we may have these natural asset companies which might be aiming to own some kind of the ecosystem services and try to convert them into assets that are financeable. So maybe it's these companies that are collecting all the revenues that we mentioned with revenue stacking, and then it's these firms looking out for financing. And I already mentioned you parametric insurance, which is an insurance providing you some kind of protection against ecological destruction and catastrophes. So it's not that it's because of the nature that you cannot achieve your nature positive outcomes. I guess now we have to have our break. Is it not?
Yes, that's true. Thank you very much, Péter.
So what I propose
for this first and very intense but very insightful session. Yes, I agree. Let's have a break, 15 minutes. You can have a coffee, you can stretch yourself, and we will wait you back in 15 minutes at 10:46 exactly in Central European time. Thank you. Well, it's time. Péter, are you here? with us?
Yes.
Thank you very much. So I hope everybody could stretch a little bit. Just a technical note, if you have questions, please use the Q&A function of the Teams, and Peter will answer your questions, or if there are too many questions, some selected questions, he will answer afterwards. So Peter, the floor is yours again. Thank you.
Thank you so much. I hope you enjoyed your break. I hope that the second part of this webinar will be less technical, so you can listen more relaxed. So what we did up until now was we reviewed the special challenges of biodiversity finance, and then we also talked about the issues linked and the experience with blended finance. So now we have to focus on what players are typically involved in this blended finance when it comes to biodiversity finance. We have as typical public actors the governments, the development institutions, very often created from international capital, and we also have sometimes multilateral organizations supporting these projects. For private actors, you have to think about commercial banks, venture capitalists, private equity firms, and just general private investors who are interested in such projects. And for philanthropic organizations, NGOs, foundations, and charitable entities. Now we will review what the role of those players are in these contexts. First of all, just to give you an impression on the importance of certain players, I have here an overview we have from 2019 on the global flow into biodiversity conservation. And as you can see, 57% comes from domestic budget. So it's government paying basically. And then we have some income from natural infrastructures or biodiversity offsets. When we go towards green financial products, they just account for 4% of the total spending, and philanthropic conservation NGOs only 2%. So and then nature-based and carbon markets only 1%. So when we talk about the importance, you need to see clearly that still a public finance dominates here. Now, what are the roles of these public players? On one hand, it is them to reduce the risk and provide incentives so investors are interested in doing biodiversity projects. They also have to set up the frameworks and partnerships. It's their job to create a special organization, maybe for collecting the different kind of blended finance sources. So they have some kind of guarantee that everything will be in line with regulations. And then the technical assistance and market incentives, very often that's a standalone institution that would monitor the performance, the biodiversity performance of these projects, and help to testify that the product is green enough or biodiversity friendly enough, so there is no greenwashing happening on a market. And then correcting the market failures, so taxing whatever has a negative biodiversity effect and giving a subvention to biodiversity positive effects. Philanthropic organizations, of course, they provide some free capital, so subsidizing, but beside of that, as I already mentioned, they play a very important role in risk mitigation. I mean, just imagine if there is a well-known nature protection organization taking part in a project as a financer, and everyone would believe that because they are in there, they will have a very strong control over the quality. So it's not a greenwashing bullshit here what we get. So if I invest in here, I can be very sure that we get the biodiversity targets too. They sometimes only make an investment, we call it catalytic investment, in order to attract far more investment. So maybe they make a tiny little donation. No one expects them to have a lot of money, but because they are in there, they show with this action that they even are ready to sacrifice some money for that, and they will be involved. They will not run away. It's not just that they have been invited for the initial press conference where we presented the new project, rather than they will stay with us. And this will boost the interest even of private investors. They also help in capacity building, so the society can take up more of such projects, and they can develop and manage more of these projects. Very often they would do some trainings, teaching people how to do biodiversity projects, or maybe financing a webinar for teaching you how to use blended finance in biodiversity projects. And then they might be the ones providing you the technical assistance. Sometimes it's them doing it, sometimes it's the government doing it, or they can do it jointly. Then we have the private actors. They are the ones providing most of the capital, we hope. And it's their job to do the project implementation, because it's them having an expertise in managing projects. And notice that even these projects need to have an efficient management. So it's not okay to although I guess you all have some experience with government financed, government managed projects. Maybe they are far too small, too slow, and then they are not very flexibly managed. Maybe you see that the financing is not done optimally, or the purchase, the public procurement takes very long. So it's better to leave it up to private actors. Plus, private actors, at the end of the day, will take away most of the return. So they will be highly motivated to be innovative, so they can do it even more efficiently, faster, with more of the effect. So next time when they do a similar project, they will earn even more money. Now, of course, private capital has a lot of concerns. Even though now we don't only have a biodiversity project, but a biodiversity project where we go in there with a blended finance. Still, the risk perception is not perfect. So it's very hard to measure the risk of this project, because biodiversity effect is not directly available. The project life cycle, as we mentioned, it's far, far longer than normal. The cash flow pattern is really crazy, because initially you have a lot of investment, and then across 30, 40, 50 years, you have a very risky cash flow, and you don't really know what will happen, because across 50 years, there could anytime come a natural disaster destroying everything that you did. So it's not like traditional investments where you set up a company, and if you don't fail, then there will be a step-by-step increase, but we hope that there will be a steady positive cash flow for the rest of the lifetime of the company. Here, there is always an outside effect. This uncertainty of revenues and the dependence on subsidies adds an extra risk. Plus, they are always afraid that if the political support goes away, then maybe the subsidies will be annulled, and they stay there with a project which is not feasible from financial point of view. The legal and technological complexity now means something different than earlier, because earlier, classic finance, your legal and technological complexity would mean you have to invite engineers who have some experience in that field, some lawyers who have experience in this field, and then they will solve this. But in this case, we don't really have lawyers with high experience in biodiversity projects. Plus you have extra complexity because of the blended finance. So you need here a lawyer who would be specialized in biodiversity plus blended finance and financial engineering. It's a very niche field. And then when we talk about technological complexity, it's not engineers we need, rather than biologists. And these two kind of experts are very different to talk to, and private investors have already some experience in how to deal with engineers estimating things and requiring some investment, but they have difficulties in judging how to deal with biologists saying that maybe, probably, there is a likelihood instead of just formulas and calculations, what we are used to in case of engineers. Then very often, because of the public capital involved, plus because of the complex financial engineering behind, plus because we need a certification from biodiversity side, we have special disclosure requirements. Basically, you have to publish far more data about a company than what you would in case you would be involved in traditional projects. And that could be something that frightens away private investors, because they believe if they publish key information regarding their projects, then they will suffer all the risk, but other competitors may learn from whatever they did and they will be more successful. So by telling them our secrets and our experiences for free, because these disclosures are public, we will promote their success and make our success just harder. And the same is true with the investment labels. We have to achieve that some certification is given to our project, but to achieve that we have to share a lot of insider data that we usually keep for ourselves, so that we can learn from that, so we improve and we are more successful next time. But if we share it with public, then competitors will be more successful because of our experience. Then for assessing the impact of the project, we have a multitude of different systems measuring whether we are really nature positive. But beside of that, there is a special challenge to analyze data. There is a new type of data. We have to collect somehow data on biodiversity. It's already pretty complex. And then we need to interpret this data in a way that our certifiers would be happy with our result. And the data collection itself is already very challenging. I mean, how do you measure the number of species in a habitat and the population of certain pieces? It's not something traditional you would do in a classic project, but you have to publish this data so someone could certify your results. And then you need to do some stakeholder reporting. It's very different from classic projects, because there you would, of course, publish some financial information, maybe some daily or yearly report on your business activities. But here you need to report your performance to a wider range of stakeholders, and those stakeholders may not be qualified in reading these reports. So you need to use a special language, you need to use special channels to reach them, but this would be again a way to measure your impact. Then you can of course measure the impact by tracking somehow environmental, social and economic outcomes. It is just to measure these impacts, you need to be there. So maybe it is an interest of the company to do the measurement, but once you are an outsider, you want to track whether their performance is fine, you want to double check whether these outcomes are realistic, but then it is pretty hard for you as an outside stakeholder to figure out whether the reported numbers are in line with the reality. Then how you can assess the impact is by just checking whether the governance is inclusive. So you would involve into major decision all the most important stakeholders. You would ask the farmers, the tourists, the local entrepreneurs, the municipality, and so on, and check how those meetings would be running. And then, of course, a way of assessing the impact would be just checking the transparency. If they have a email where you can ask questions and they tend to reply pretty fast, or they have a hotline you can call, or they have regular meetings where you can ask questions, that would increase the support of your project. And you need that because this performance measurement will go on for several decades. And whenever they have some doubts regarding your impact, then all of a sudden your project could collapse because of the lack of public support. What are the major risks for such projects to do? On one hand, the disproportionate risk bearing is a challenge, because we earlier saw that we need someone to take up most of the risk without taking up most of the return. And then it might be, if it's up to the private investor to create the construct, that at the end of the day, the private investor takes up nearly no risk, but takes a lot of return. And this way they take profit of having some kind of green finance or biodiversity connection of their project. And this would attract a lot of free riders who would try to take profit of pretending to be green. Then it might be that the project would inefficiently use the public sources, because the cost of public sources is not with this project. So we need to assure somehow that the public funds are spent on the projects that would bring the highest benefit per unit of money spent for the whole society. We have some moral hazard, because it might be that investors who do not anymore take up the total of the risk will go for either far too risky decisions, because now private investor is not taking up the risk, but someone else does. And if there is a huge return, they will benefit from it. But if there is a loss, they don't lose anything. But on the other hand, it might be that stakeholders or the public finance provider would take over the control, and then they will take again suboptimal investment decision by spending on low risk solutions rather than fair projects. They always have some kind of preference for not risking anything that is there already, and this is rarely leading to high return. Then another classic problem is that we are afraid that at the end of the day there will be no impact of the project. So we use up a lot of private and public capital, and at the end of the day the impact is only that the private capital earns a higher return, but there is no nature positive effect. We may be afraid that risks are badly estimated. So we redistributed risk, but we redistribute the estimated risk. If the risk is far, far, far higher than that, then maybe after the first or second challenging year, the whole project collapses. And then we might have a project selection bias. I mentioned you already that one, that greenwashing may distort this, or it might be that financing would not be allocated, public financing, based on the outcomes of the project, but maybe based on personal connections with the decision makers. The impact attribution is a challenge, as I mentioned. It's hard to figure out how much of the positive change in biodiversity or nature can be allocated to our project, because maybe even without the project there would be some improvement or some changes, and it's hard to tell apart from the total what is actually caused by our project. And then there is a sustainability risk that maybe we have some kind of capital to start the project, but as we go on, we will need more and more of capital or continuously some kind of subvention. And we are afraid that maybe we can start this project and do it for 1 or 2 years, but then all of a sudden this won't be sustainable anymore because the either a part of the capital or a part of the subsidies will disappear. So we need to offer them some kind of guarantee that this would not happen. Now, to do a blended finance project, we have an industry-wide principle set of 5 items which we should consider so that our blended finance project could be a success. Point 1 is the economic rationale, which means that additional development impact shall be achieved. So it's not that we do the project and there is no positive outcome. If we use some public funding, then we should be able to show that due to this additional public funding, there is an added development impact on the top of what private capital would achieve on its own. The second requirement is that there should be something called crowding in or minimum concessionality, which means that we only add public money to the extent that the project is feasible from financial point of view. You should not add extra amount which would boost profitability only or reduce risk, but kind of being waste of public money. Then it should be commercially sustainable, which means that sooner or later whatever we create should be operating on its own, and it cannot be that public money is continuously needed to save the project. So there should be some kind of financial model that would make it sure that there would be a standalone project created which is operating on its own. We should reinforce the market with this blended finance project and not destroy the markets, because sometimes by providing just random labels to products saying it's more green, it's top quality or something like that, at the end of the day, if there are too many certifications, customers will not understand the difference across those certifications, and maybe there will be no price premium to be paid for it because they are not convinced that these certifications mean anything, and then it will be just distorting the market instead of helping the really green projects to achieve a higher return. And then the very last requirement is that we should always promote high standards. So we should always require these projects to show strong governance, full transparency, and there should be a rigorous oversight ongoing continuously, no matter how transparent they are, how good the top managers are. There should be some kind of office overlooking these projects and continuously checking whether they spend the money they are meant in a way they are meant to. So if you can assure that these 5 principles are met, then you have a far bigger chance that your blended finance projects will be maintainable in a longer run. There will be no political attacks on them. They won't be cancelled soon later. They won't be seen as a form of bribery or misusing of state funds. And you may hope that you will use public funds efficiently. Now I have collected some examples for you, so you have an impression how blended finance tools may work across Europe. Now my very first example is coming from Albania, Greece, and North Macedonia. There is, I hope I pronounce it correctly, I'm really sure if sorry if I don't, there is a Prespa Ohrid Nature Trust, which was created once upon a time by the MEVA Foundation, the German Ministry of Economic Cooperation and Development, and the German Development Bank. And this trust is basically collecting public money, German government, and just some philanthropic money from the foundation. And the aim is to provide resource for local projects that would be carried out in these two areas. You have a wetland there, and there is a lake, I believe. Of course, if we have some audience from these countries, maybe you have a far better understanding of this project. The idea is to protect these two areas which are located next to each other, right on the border of these three countries. And the trust was created to merge money that will be supporting privately funded individual projects, very often also municipally funded, to promote biodiversity in this region. Now we have also another one, the Interreg Urban Green Belt project that hits Austria, Croatia, Czechia, Hungary, Italy, Poland, and Slovenia. And they have as a target to manage urban green spaces smartly. In this case, we have international source, EU money, and we also have, because it's co-financing projects, municipalities, so local public funding, in order to change the way cities are using their existing green areas. For example, to create a green corridor across cities so pollinators can move across the city freely, or to increase biodiversity, make green spaces more accessible to locals, and to enhance the biodiversity products, if you want, biodiversity services that these green spaces can generate. We have various examples from these countries, and the project has its own home page where you can find out more regarding these projects. Then we have here a very interesting one from Finland. We have the Rewilding Europe Capital, which is not providing you equity contribution rather than loans, so that you can finance your biodiversity positive projects. And in this case, we had some local landowners and enterprises which were cooperating to purchase a former peatland mine. You see, peatland is whatever you have in wetlands, and once it was a mine, it looked like the moon surface. There was barely nothing living there, as you see on the left picture in Linnunsuo. And it was purchased in 2014 using this 75,000 euro loan. And as the BBC stated recently in a report, it was transformed into a biodiverse heaven, because you have there a lot of birds nowadays, and of course other wildlife appeared back, because water was led back into this area, so now it's a wetland again. Then we also have, this example here for reviving Europe would be coming, of course, from Finland, but I found also examples from the same loan source that went to Portugal and to Spain for financing different kind of projects. I guess in Spain there was some kind of safari that was set up, so there is a monetary income even generated from that project. But for an example in Spain, so that it's different from the earlier ones, where we have seen examples of collecting already public and philanthropic money and then targeting it into privately financed project. In case of Albania and Greece, we saw an example earlier where we provided just public sources, international public sources, and went on using that with local public sources for the green belt. Then we have seen here an example where we provided loans, a kind of subsidized loan along with private capital to achieve a change in biodiversity. Now here we have another kind of foreign capital, but it was a sustainable bond that Castilla y León has issued worth of 500 million euros for 10 years in 2023. And they said that the inflow of these bonds would be also allocated for forest fire prevention and restoration and conservation projects. And also from the same region, the European Investment Bank signed recently an 87 million loan for co-financing a series of green investments in that region. So you see here there are two examples. First one is where you want to channel in private capital into some biodiversity project by creating a special bond which would promise you to take part in certain biodiversity positive effect. And then the second case is where you have an international development organization that would provide you a loan for the same purpose. So these are techniques to invite in additional capital to your biodiversity projects, various ways, international organization, private owners, philanthropic, and then the so that it could be either a loan, could be a capital or grant. And then to give you an example on the support that you may offer, I saw that in Portugal there was a think tank, Nature Concept PT, generated and set up in 2023 November, which was established exactly to foster international collaboration and identifying barriers and co-creating innovative solutions to achieve biodiversity targets. So this is basically a think tank that is something that is meant to connect different stakeholders in order to have successful projects, to collect knowledge that is needed for a successful biofinance project finance, and maybe offer policy recommendations so that they could promote with consulting the purpose of blended finance. Now let us see what are the typical hurdles across Europe to implement these blended finance solutions for biodiversity projects. First of all, we have country-specific regulations. And how that's a challenge is that these country-specific regulations regarding how you can use public funding, how you have to do special reporting if you use public funding, how you may testify that you have a biodiversity positive impact, and so on, will hinder that knowledge and expertise would be flowing across borders. While in case of classic financial products, if you developed a mall in Berlin and then you went over to Prague to do the same, then of course you have some regulations, but basically you have an idea of what kind of regulations you check. And if you hire a local lawyer, the construction is done exactly the same way, the market rules are the same, finance is the same. So a lot of international expertise can be used in other countries. Unfortunately, because of the complex regulation of public funding and then reporting requirements, and also because of local language needed for contacting local stakeholders, it's not true that if someone was good enough managing such a project in Greece, would be very successful doing that in Portugal. So because of these country-specific traits, you will need always locals to have local expertise, and that will make it longer for this technique to spread across Europe. We also have multiple overlapping directives. Some rules would talk about what biodiversity is, then we have the EU regulation on what green bonds are, and then we have a local regulation telling how environment protection can be done and what are relevant targets, and then we have UN-wide requirements on targets, and it is impossible for one to overlook all these possible directives. And because the directives do not have one single set of definition for the same thing, maybe something qualifies as green locally but not as biodiverse internationally, and that will make harder to invite in foreign capital. If you are in line with local regulations, you cannot ask them to join. If you are in line with international regulations, maybe you have local hurdles. And then you have very often sector-specific barriers. Agriculture is a classic regulated area where you might do biodiversity positive projects. However, because of all those regulations linked to the sector, you need to know the local regulations, for which you usually need to speak the local language. And whenever you understood and learned how to do it successfully in agriculture, it will be difficult to take your expertise over to tourism, because there again you have some extra regulations, so you will always have to invite in new experts who can advise you on those. Then we have some regulatory gaps in cross-border planning and financing. So sometimes there is a requirement that there is someone local who will do it. You need a lawyer with a local license, you need an auditor with a local license, and also you need someone speaking the local language to set up the plans. Then you need connection to local decision makers, stakeholders, and the cross-border usage of capital is challenging also, because if you take some public funding from a country and move it to a different country in order to achieve a biodiversity aim that has its positive effects only locally, that's basically saying that your home country's biodiversity is less important than the target company's biodiversity, and that might be politically really challenging and hard to explain. So as we have seen, that's why I picked that example. Basically, the German government said that we should spend some money in protecting biodiversity in Greece and Albania and North Macedonia. instead of spending the same money in protecting environment in Germany. And that could also be against local regulations on one hand, or could be hard to explain to voters. And just generally, there is a very strong call for standardization and transparency from the whole industry. So on one hand, there should be one set of rules. So if you're in line with those rules, no one could say that there are some additional more rules to follow. It would be great that, let's say, there is one EU-wide regulation on how to measure biodiversity outcomes, what are the KPIs to follow, when do you qualify for to be green, and then this would really cover all the areas of biodiversity. Also, transparency requirements are pretty different. Just imagine if you consider the financial transparency, then what EU did was, instead of trying to harmonize all local accounting standards that are used in membership states, what they did was they simply said that anyone who is listed in any of the stock exchanges or who is running a financial service company within the EU, they should publish all their financial statements also in line with the IFRS, the International Financial Reporting Standards. And then this way, all those reports became directly comparable. Now, we don't have this currently in biodiversity or nature-related reporting. And because of that, we cannot be sure that if you qualify in one country to be green, then you would qualify green in another country with the very same project. So it's not that, okay, in Finland we did something very successful, let us take this example to whatever, Slovenia, and then use it there because we already know how to do it. Because maybe in Slovenia, the first step will be that they say, oh, it's not even a positive biodiversity positive effect, and then we have to stop the whole thing. And the same is true with transparency. It's not okay, or it's not possible to contrast different reports on biodiversity effects, because there is no standard what you have to report. And even if you report seemingly the same ratio, maybe you calculate the ratio differently, meaning that even if you have another project with all the KPIs reported being higher than yours, there is no guarantee that they are a better project than you are, because you might measure the same KPIs differently. And there is no need that you publish exactly the same KPIs. It's up to you to pick something, and then we hope that you would measure that in a proper way, so at least we can contrast your current year's performance to last year's performance. But there is no real guarantee for that, because there are very few of such biodiversity projects. This challenge was not emerging yet. But we have seen this already on the international financial markets. So why investors were originally not willing to invest into less developed countries was that they used the local language and they used the local reporting standard, and they had their own local law system, and the legal system was too different, hard to understand, and the reporting was not transparent enough. I believe that we are going towards the same direction, where we will sooner or later, once we will have a more developed biodiversity market, why we won't have this biodiversity projects spreading fast will be that we lack this kind of comparability and transparency. Okay, once we just focus on financer challenges and not all the regulations, whatever, across Europe, then we would again face a multitude of problems. Yes, currency risk is there because you may have member countries which would not use euros. Of course, within the Eurozone, it's convenient because even if you have some international development sources, those would arrive in euros, your costs would emerge in euros, wonderful. But in the minute you move to member states without euro, or you go to states that are not members yet, like Albania, you will have currency risk. So funding would arrive in euros, and then your income is in euros while your expenses are in local currencies. And then because of that, there will be always a translation risk and loss depending on how currency rates would fluctuate. And you see, over 30, 40, 50 years, you have far more currency risk than for just a 10-year project, and the currency rate is far harder to predict. Then we have the country-specific barriers, legal barriers, language barriers, and then also the political barriers. Maybe some investors are not so welcome in some countries, or some countries would be not very happy in supporting some other countries, and this would hinder the spread of sources. Then we may have also barriers regarding the funding of NGOs. So some countries would strongly monitor where money is coming to for NGOs, or coming from for NGOs, and then if these NGOs are in biodiversity, they are still hit by these barriers. We might have market imperfections where we don't measure some externalities, or we even give a subvention to solutions that have a negative biodiversity impact, and that will make it harder to promote biodiversity positive solutions, because these would need extra subvention, but subvention is actually going to competing technologies. Let me give you here an example of a real-life bandit finance project, but because I was involved in that, I'm kind of asked or forced not to share specifics. But imagine when you have some funding from government, private sources, banks, and then international EU grant to create a geothermal power plant, which would generate you hot water that you could use to sell energy to district heating system. And then you set up this system, and you have a kind of regulation which would regulate the price of heat to be sold to district heating systems. And on one hand, initially, when you apply for a public grant or grant with the EU, you have to prove that there is a lack of return in this case compared to the return required for the level of risk. Basically, the green solution costs you more than a solution that would be based on using natural gas to create the same amount of heat. So, of course, a market-based decision would be not to use geothermal energy for the power plant, but natural gas. So you have a EU-wide grant where you apply, and because your application is convincing, you win actually the money. A grant, in order, you have to put in less of capital so that the same amount of energy sold would create you a return that is enough to compensate you for the higher risk of the green investment. Now, if in Hungary you have a regulation which says that the heat energy can be sold at a price which would not generate you a higher capital based return than 5%, let's say, then everything is fine. You just calculate the price of energy, and then all of a sudden it turns out that your national regulator believes that if you receive the grant, then on the grant you should not get that 5% of return just on the equity you invested. But you remember originally why you did not do the green project was because that 5% on your equity was not enough. That's why you got the grant. Now if on the grant the 5% is not paid to you, then it's just like doing a smaller power plant but without a proper revenue receipt. So here you see that the local regulations basically take away the grant effect that you received from the EU. At the end of the day, the investor stood there with a half-ready project, and it turned out that the local regulations take away the subvention that he got from international sources and wasn't willing to finish the project at all, because for sure it would generate a loss over 20 or 30 years while he would operate the geothermal power plant. Okay? So we have to take care that regulations understand perfectly that whenever we offer a limit on the profit that someone could make, we have to consider the different kind of capitals it's using for that project in a reasonable way. Then a huge issue regarding the European market is that we don't really have those intermediaries that I was talking about. In some countries, maybe you have, but very often there is no one office either operated by philanthropic capital or by the public or government that would help anyone to set up such a blended finance instrument where you could invite in participants, and there is no one to share you the vital knowledge. So maybe if there would be, let's say, an EU-wide office which would collect all the experience from all membership countries, and then having local representatives in each member state, and that would share this knowledge, that could promote the use of blended finance in biodiversity projects, and by that all the biodiversity finance sector. The credit market sensitivity is an interesting issue. You see here that recently we had various crises in the EU, and in all cases we had a rapid and drastic change in the costs of credit and debt. And once you have a long project, like 40, 50 years, then basically it is for sure that there will be one or two such crises over that period. But sometimes we had so radical jumps in the cost of capital and cost of credit that once you sign a contract and you face all of a sudden with so huge interest requirements, that could collapse the whole project. And this is particularly important because the main purpose of the project was not to generate financial returns rather than to achieve biodiversity positive impact. Okay, so the problem is that biodiversity projects may collapse because of financial reasons which are out of their own control, and we cannot save these projects from this credit market sensitivity. Maybe if there would be credit sources that would be offered to these projects at fixed terms, that would benefit the biodiversity projects. However, it is very rare that someone would sign a contract exactly because of these volatile times. there is no one signing a contract with fixed terms for a very long period, for several decades. And finally, we have the challenge of how to involve the private sector, because we just have exactly the same problems and everywhere on the world, globally, that because of shortage of experience, we have not seen anyone who walked away with success from biodiversity projects. It's more safe not to do them and wait for someone else to figure out how to do them properly. Earlier experience with any kind of new investment types shows that initially there will be some success, but there will be also a lot of losses. And after a decade or two, all the solutions are standardized, so everything will see less of risk included, and then there is more interest for private players to take place. Now, the big question is how we survive the initial decade, and how do we convince investors to come to this field without any kind of special risk to be taken. What are the key lessons of blended finance projects in Europe that we already have seen working pretty fine, like the one, let's say, in Finland, which from biodiversity point of view is a great success? So it seems that if you have well-structured blended finance, that can create positive feedback. So once you did a project with blended finance that worked out well, then there will be others who are willing to copy. But if there is a huge failure which receives a big popularity, then there will be several years until someone else will try the same thing. So whenever you are successful, please just share this information with others and then provide a huge publicity. Then blended finance is particularly effective for projects that are otherwise far too risky and of low return. So maybe you should not use blended finance for all possible source targets and aims. Maybe you should reserve this technique for really high risk and low return projects. If there is just some return missing, or there is just a little added risk with the project, it should be probably solved in a different way, particularly because if you create a pool of possible projects and some of them are just a little more risky than normal and have a little less of return than what is required, then when you try to spend public funds optimally, they may be the optimal choice for the state to be financed, because with very little amount of money, you achieve a relatively huge effect. And this way you would not support projects with the highest biodiversity impact, but you would support the projects which need the less of capital to survive. And this way, of course, you make the biggest impact, but maybe not in biodiversity field, but in traditional financial field. So maybe you boost economy the most and increase GDP the most, but you don't achieve the biodiversity targets. We see that blended finance is something that helps countries in transition to reduce the dependence on EU sources, which is already a very good solid point of selling, because it seems that a lot of projects, as I have shown you, for example, the green belt across cities, are financed from EU sources, and maybe some EU source plus some local government source is the total of the blended finance, and there is no private equity at all, which is not the healthiest solution. So it's much better what we have seen in the project for Greece, Albania, North Macedonia, where we have government money and private sources at the same time, and philanthropic sources all together. So countries that are too much dependent, particularly in case of biodiversity prevention, on EU sources, may see blended finance as a solution, because blended finance not necessarily requires EU to take place in there. And if you have these channels built up nicely, then you may have an opportunity to invite in capital from other countries without actually connecting to the EU. So whenever EU stops supporting you or reduces this kind of supports, then you can still survive. And then, of course, if you have clear policy roadmaps, long-term commitments, and you promise that you will reduce the risk associated with all the innovation, upfront investments, transaction costs, contacting all the stakeholders, and so on, then you are more likely to succeed. If you just make unclear promises, or your promises are valid only until your political term, then unfortunately this increases the risk of these investments and would not decrease them. And this is why it is more healthy to set up some kind of regulation and not change it for, let's say, a decade or so, and then collect all the feedbacks from the industry and modify the regulations once, and then keep it unchanged again for a decade or so. So the market could adapt to the local or current regulations. And it's not that every week, every year, every month, we would change the regulation, ending up with creating more uncertainty, which is just the opposite we wanted. Okay, now what are some of the areas for improvement? How could we promote this blended finance across biodiversity in the EU? On one hand, we have to do something with the complexity and the high structuring cost. One method would be to set up a huge fund of blended finance, and then the different projects that this blended finance could help with would be selected by a special team for each country, or we could create a blended finance instrument which works EU-wide, and then they could pick the projects. The problem with this later solution would be that the international sources would be spent at a national level, and then it's harder to achieve that we have some kind of balance across member states. So instead of that, maybe it's better that you create these financial vehicles at the national level, maybe also with some EU support, and there you create some kind of blended finance instrument centrally, and then just like the solution we saw in Albania and Greece, we let these privately financed projects to apply to this blended finance vehicle for support, and then they can set up the expert team, the think tank, just like the one we have seen in Portugal, and then they can concentrate the knowledge required for financing at one location and reduce the transaction fees for all the projects they choose to invest in. We need to do something also about standardization and transparency. It seems that differences in local regulations make it far harder to spread know-how and best practices across the EU. Also, if there would be just one regulation regarding on what kind of information you have to publish and what would qualify you to be transparent enough, it could help everyone to set up companies immediately like that, and evade a tax for not being transparent enough or not being comparable with other projects. And also that would help us to evade a tax for spending public money not in an efficient way. Why I said that it is probably better to have this blended finance vehicle organized at the national level is that we have to align the aims of this blended finance project with local priorities. It will be hard enough at national level to balance across different local priorities. One part of the country willing you to plant more forests and another part of the country willing you to focus on wetlands or God knows what, and you need to set up priorities. It's hard enough, and you should not just go for an international level of comparison so that there is an EU-wide priority for restoring seashores so that member countries without a seashore would fall out of the program. So this is why it's a huge challenge, even at the national level, to spend the limited amount of public funds. And the local priorities could be very different across countries, across regions. And there should be some kind of platform where these priorities are set. There is a nationwide, at least nationwide strategy that is in line with all these priorities, and this strategy is followed by that one investment vehicle created for the blended finance solution. Then we should also develop our intermediaries, so we have agents that promote this kind of financing, both to investors, both to projects. We should also have someone responsible for monitoring local knowledge tank, also local expertise in legal regulations or biology, so that whenever we have a good project, we could offer them adequate support, so we reduce the risk of the investors funding the project. Then we have currently very limited bankable opportunities because banks, because that's why they are created, would focus on financial return. You cannot say to your depositors that why you don't pay a high rate on the deposits is because you have lended money to biodiversity positive projects and there you earn a low return. Because maybe this would not promote the bank across depositors, because depositors focus on higher deposit rates. Of course, probably if you set up a green bank that promises you to finance only green projects, maybe you would create some or still get some deposits. I have no clue, but it's a huge risk to set up something with that limitation. So currently the problem is that the private engagement is not holding stable or something like that, but like 5 years ago or somehow like that, when there was a boom in interest, then everyone was seeking whether these biodiversity projects would offer a better return or a bigger opportunity for diversification. And currently there is a declining private engagement because they realize that there is nothing like that, and there are not even opportunities, safe opportunities for private capital to go into these projects. And we need to make the projects bankable, which means that it's not enough that we have some very enthusiastic biologists explaining that if we would spend a lot of money, there would be a lot of species showing up in this area. But we should explain somehow also in the language of finance, how is that advantageous for the guys providing the money? Because it's no way that there will be just public sources financing all that. We need private capital, and for that we need to have a proper financial model where we prove that if the bank provides us some kind of loan, maybe at reduced rate, but still we will be able to repay all the interest and all the principals on time. For that, we have to assure that we have a proper way of collecting money somehow from all the biodiversity services that our projects generate. If we cannot convert projects into bankable opportunities, there won't be bank loans and there will be no private engagement, and then public sources are not adequate, so biodiversity targets will not be achieved. Finally, we need to find a way to solve the issue of scalability. Very often we have a one-time solution for a problem, and then if I want to solve a similar problem with a size of 5-fold, it's impossible to do because these all had one-time solutions and there is no repeatability. We cannot do it in a bigger or a smaller size, and because a lot of biodiversity projects are absolutely unique, there is very often a unique financing structure created for them, but it's not a necessity. If we could create some patterns that could be applied for similar projects with bigger or smaller size, and there would be, as we said, some kind of intermediary which would assist in that, then we could have just more of successful projects. Now, let us see what historical experience shows us for success factors. It seems that there are some traits of projects which make it more likely the project to be successful. So if we focus our projects to be like that, we increase the probability of success. On one hand, we should have a very strong governance and stakeholder alignment. So if we have a lot of different partners, there should be some kind of board where you collect all of them so they can agree on key decisions. So we keep the stakeholder support for long run. Notice that we need to integrate somehow not only national government and local authorities, but also local communities, private sector, and then even maybe within communities and private sector, you have various groups of interest with conflicting interests, of course, and you need to consider all of them. Like the classic one is where the farmers usually don't agree with those owning forests and doing hunting because the interest would be that there are less of animals eating crops from the agricultural area. Why, of course, if you are a hunter, you are interested in having more of wild animals. And these both belong to the private sector still with conflicting interests, or you have different communities and then maybe the communities representing tourists and those who like to visit forests would have a different interest than the communities who want to have better traffic and more highways that lead across these forests. So we have a wide range of different interests, and we need to achieve right at the start that they all support the decision we take, and we have regular meeting with them, and we don't lose the contact to them, because just the protesting of one of these groups could block very good projects forever. Then we should have the projects led by local interest, local well-known faces who can represent in front of local communities the project itself, and whom local people may trust. It's not optimal to have a leader that comes from the other end of the country. No one knows him, or he's a famous politician and he's famous for changing parties every 4 or 5 years. That would be not optimal for a project that lasts for 50 years. So we should let local communities to have more of involvement, and if they feel like they are kind of owners of the project, that helps sustainability and social acceptability. And it seems that these biodiversity projects would simply not survive without local support. So you may plant a forest, but if local people would cut it and burn it, then you cannot do anything against it. Then you need to assure that there is adequate technical assistance available. So it's not because of one legal document missing, or a law not respected, or something like that, that the whole project would stop. It seems that blended finance needs far more of technical assistance than traditional finance. Why? Maybe, I guess your country has the same problem, but for example, in Hungary, we already have a special technical assistance and special help for small and medium enterprises to take some loan, because you need to apply for loan, and then the application may be harder to fill in, or the financial plan needed for the application is harder to create for smaller firms with less of financial experts. And also for traditional projects, we see that they need some kind of assistance. Now for blended finance, it's even more assistance needed, because that's far more complicated. And this support is not a one-time support like in case of a debt application for SMEs, where you help them, they apply for loan, they get the loan, and then they use the loan, repay it, but you don't need to assist them for, during that period. Here, assistance need is ongoing until the end of the project. There should be an independent monitoring, reporting, verification system, so we can assure that whoever says is biodiversity positive is really biodiversity positive. And the risk and return expectations should be brought into line. So whenever you are an investor in a nature positive project, you need to accept that it is at the cost of financial return that we achieve some nature positive outcomes. So you will never get higher return because of doing nature positive projects than normally. It's the opposite. You will get most likely lower return, and that will make it harder for private investors to take part if there is an additional image effect from their side, so that they can say, okay, I've invested so much into green projects and it's independently monitored. It's not me saying it's green, it's others saying green. Then maybe they are more ready to accept that the returns are lower. And finally, the integration of multiple benefits should be done. Somehow we have to achieve that all these different benefits are somehow linked to our project, so we can explain everyone that we did just that project, and this is because your climate is better, your biodiversity is better, you have better livelihood, you have an increased level of health, your cultural heritage is protected, and we have to present all these so people would understand why we did it and how extended the non-financial returns are, because as I said earlier, otherwise these outcomes are very undervalued. People would doubt whether those values or value creation exist at all, and it is hard for them to sit down and consider a project and list all the positive effects. So you need to spend extra effort on communication, finding all the positive outputs of your project, so you can get even initially financing for that, and later on so you can keep the public support for those projects. This was it from my side. I hope I kept the time. Thank you so much for your attention. And now I will try to answer some of your questions.
Thank you very much, Peter. I think it was very exciting and very relevant for our partners. So thank you very much for that. We received some questions. I don't know if you want me to share these with you, because I already collected them. Just a moment. Sorry. I think now it should be visible. Can you see it? See them, actually?
Yeah.
Okay. So we have two questions from Greece, from our partners from Greece. And one question, or maybe it's a tricky one or just an interest from Finland, the last one. So the first question is that are debt for nature swaps, blended finance structures converting debt obligations into nature conservation funding currently active and successful? This was the first question by Yanis, but I think it partly has been answered during the examples, but I give you the floor to answer it.
I cannot give you a real life example in this case from EU. I believe they used it, for example, when I checked the literature, they quoted an example from El Salvador, but I don't know of any Hungarian or any EU-wide examples of that. I just quoted this as an example that someone has tried that, somewhere it has worked, but I'm not very sure whether this is something we could introduce in the EU-wide regulation. And also, there is no EU-wide regulation, so even if we would have an example of this financing in any EU countries, we would always have the problem of whether that would work in another country. So we need to investigate how that exactly happened there. But I cannot help you with telling how that is successful or would be successful in Europe.
Thank you very much. The second question is about the PONT example, PONT, which is considered encouraging according to Yanis, with its transparency and accountability, and very important, its financial that it is financially sustainable. However, do you think that such approach would be possible also in smaller scale, like a small municipality?
I definitely believe that we have to separate projects from the funding vehicles. So you set up a funding vehicle where you merge, just imagine like it would be a company. And then in that company, you merge different sources of financing. That's the blended finance. And then this company would decide how to spend the funding on different kind of projects. So maybe that they, as a kind of, it's very similar to commercial banks where you collect sources of different lifetime and different risk, and then you generate different types of loans of it. So in this case, if you have this amount of capital available for biodiversity from blended sources, then you can pick smaller and bigger projects to finance by it. If I understood it correctly, this is something that this fund is also doing. So there would be private entrepreneurs with their own projects applying for support. And if they like the project, they would add some kind of co-financing with it. So if there is a small municipality then I believe they could apply also for the same proportionally smaller amount, bigger city for a bigger amount, and then if this blended finance entity would have the expertise, they could just scan the biodiversity KPIs and figure out whether they qualify the requirements and how they best spend the total amount that they collected. Like it would be an investment fund we have in financial markets.
Thank you very much, Peter. And the last question is not really a question. I can feel it like as an invite. Are you familiar with the situation of North European forests? And have you visited them in Finland, or would you like to visit Finnish forests?
I have never been to Finland. I would be very happy to travel to Finland and visit also forests. I'm not very sure why that question was asked, because as far as I know, but maybe I'm misled, because of course you might be biologist and you have a far better picture. But my impression was that in North Europe, maybe those come from Norway or Sweden, forests are in a pretty good condition compared to some forests like in other countries. I could name some areas, but myself, I'm not a biologist, so my impression could be totally wrong. I'm not very sure why this question came, but I really hope that it's still a success which I quoted regarding that SWAN plan in Finland.
Thank you very much. Maybe Jana will continue chatting with you about this issue. Thank you very much.
Definitely. Anyway, I guess everyone will get my slides, and at the end on the last slide, you would have my email. So if you need to contact me, I'm very happy to assist you if I can.
Thank you very much. And also, I would like to thank you very much for your presentation, for the insights we got, because I think it was very important for our project. Also, thank you for the participants for being with us today, asking questions. Please follow the project, the NATUREFIN project, via the LinkedIn or on our website. And if you have more questions, you can still reach us. And thank you very much for everybody for being here. And with this, I will end this session, and I wish you a very nice day for today. Thank you very much.
See you all. Goodbye.
Goodbye. Thank you.